Good day everyone. In this video, we have Mr. Kashyap Javeri, co-fund manager of Emkay Investment Managers. Good morning, Kashyap.
Good morning, Sonali.
So FY23 has been quite resilient so far. As a fund manager, what is your outlook for FY24?
I think, Sonali, what we are following today is a 5-point agenda, and which I think will not only sail us through FY24, but I think it's going to sail us as an equity market and India as a country for next about 3 to 5 years. And when I talk about that 5-point agenda, that's something that we are going to consistently, keep checking on, keep looking back on, and keep revalidating over a period of next about 3 to 5 years. On that 5-point agenda, the point number 1 is, we look at the productivity of the manufacturing sector or productivity of overall economy. And the ratio that we clearly look at is cash return on capital employed. And today that ratio is at a high of almost last about 12 to 15 years, which means that the productivity of the economy of the manufacturing sector overall has improved quite a bit. Point number 2 we keep looking at is how much deleveraged the balance sheets are on overall level for the economy as well as for the companies which are within the listed space. And clearly over a period of 5 years we have seen dramatic improvement not only of, let's say, overall indices, but within indices, if I keep if I look at some of the most levered sectors which are like, let's say, ferrous metal, non-ferrous metals, we have seen dramatic improvement. Point number 3 that we look at is supply side response, where we look at what has been the capacity expansion announcements, and you cut across the sectors, whether it is ferrous metals, non-ferrous metals, building materials, you look at specialty chemicals, defense, so on and so forth. We have seen most of the companies announcing capacity expansion across the board. Point number 4 that we look at is what's the policy response from the government as well as from the RBI. And what we have been looking at is that a clear-cut chart in terms of how the fiscal deficit and how the fiscal expenditure is going to progress over a period of next 5 years, where FY21 budget clearly outlined the fact that for next about 5 years, our capital expenditure is going to grow at double digit. And point number 5 that we look at is from the financial industry point of view, how deleveraged the balance sheets are of the financial companies today, right? Because if I'm going to look at point number 3 and point number 4, which is the capex of private companies as well as the government, there has to somebody to fund that capex, right? So we look at the financial industry. If I go back 5 years, in 2017, there were barely any banks besides private sector banks which had a tier 1 capital ratio of more than 10%. Today, there are about 34 listed banks, and each bank has got a tier 1 ratio which is more than 10%. If I look at the provision coverage ratio of the banking system, there were barely about 5-6 banks in 2017 which used to have a provision coverage ratio exceeding 65%. Today, almost 100% of the banking industry has got a provision coverage ratio which is exceeding 75%. So you have a fairly sound financial industry today which can fund this capex. I think if we are going to progress on this 5-point agenda every year, even if it's marginal and we are not going to deteriorate on them, I think it's not only FY24, but I would say probably till FY27 we are going to see both the Indian economy as well as equity market doing fantastic for the investors.
So you're clearly very bullish on the manufacturing sector. What makes you think that this sector is going to do really well over the next 3 to 5 years?
Some of that 5-point agenda is also related to our bullishness on the manufacturing sector. What we have seen post-COVID is, sort of consumer has become really vengeful on spending money. I think initially a lot of people thought that this is latent demand, and just because people didn't consume during those 3-4 months of lockdown, probably they are going to spend more for initial 5 to 6 months. But if you look at today also, companies like Maruti, Mahindra and Mahindra, Eicher Motors, they are reporting significant amount of order book spending on the deliveries even at this point of time. I think what has changed from a consumer point of view is that for the first time in 7 years, if you look at BSE 500 companies, the salaries have grown at double digit. We didn't see this for almost about 7-8 years in past. If I look at today, the wealth effect on the overall Indian consumer, because the debt funds, equity, everything has done so well, including even gold and real estate, I think he is sitting on a fairly strong balance sheet. Last about, let's say, 7-8 years, they haven't borrowed much from the banks, which means that on their balance sheet, they are looking at a fairly healthy, debt to equity ratio also on a personal balance sheet level. I think that consumption boom is going to continue for next about 3 to 5 years based on the fact that we believe that the per capita GDP is going to grow at double digit. The balance sheets are pretty healthy for them to borrow more money from the banks. From the manufacturing point of view, if I look at that 5-point agenda, I think 2 things or 3 things clearly stand out. One is the productivity of the sector has improved dramatically in terms of their ROCE. Point number 2, their balance sheets have improved dramatically in terms of debt to equity. And point number 3, because of these two, they are now more confident of laying on more capacities to meet the kind of demand that we are seeing from the consumer point of view. Last but not the least, now that consumer and manufacturer both are sort of back in one of the best health, there is a fair bit of policy response also coming from the government, right? So you had 2019 budget which reduced the taxes dramatically. You had 2021 budget which clearly outlined the capex for next about 5 years. You had Atmanirbhar Bharat, which clearly outlined about 2.5 lakh crore worth of incentives from the government. So I think government has also realized that eventually when this kind of consumption boom comes in, to rely on global supply chain will sort of be a folly. It could be a fallacy on our part, and we need to have a supply chain which is more domestic in nature, and which is why we believe that manufacturing over the next about 5 to 10 year period will see a similar sort of behavior at its saw between 2003 to 2011, provided we control also one of the an outcome or a menace of that consumption, which is inflation. If we can curb that, I think next 5 to 10 year definitely belongs to manufacturing.
So just kind of following up on the entire consumption boom that you're talking about, what do you currently think of the consumer trends in India and in US?
I think let me first tackle India. I do believe that last 5 to 7 years, or let's say last about almost 10 years between 2011 to just starting COVID, about 2020, probably for India was kind of a lost decade. We had salary increases which were in single digits. I'm talking about generally at the the economy point of view, not a particular sector, but overall economy we had a single digit growth in salaries, and which sort of took out the whole belly of the economy, which is the middle class. It took it simply out of the consumption piece. What we saw for last 10 years was probably growth only in sedans, in terms of SUVs, in terms of high-end refrigerators or high-end air conditioners, and probably high-end televisions and so on and so forth. I think as the salaries grow at double digit, as the wealth effect comes back, or rather is already there, we are going to see consumption growing faster in discretionary, and probably discretionary will take a significant part of the consumer wallet as we go forward, which means that we are going to see a significant higher growth in terms of let's say automobile, white goods, probably housing, in terms of building materials, where a lot of people, I believe, when you see this growth in the housing sales, I think what you're going to see also a significant increase in the sales of building materials, right, which includes tiles, paints, plywood and laminate and so on and so forth. So I think from India point of view, I do believe that discretionary will be growing faster than the non-discretionary part. From the US point of view, I think they have been trying really hard to curb the inflation and slow down the economy. It's not working as much as what Federal Reserve would want it to be. The problem again there is that US as US citizens have also seen the same kind of wealth effect that we are seeing today. If you look at the retirement accounts of most of the salaried people in US, they have about 60-70% equity and about 30 to 40% including US debt and global equity. About 60% of that part, which is equity, and out of the residual 40%, whatever is non-US equity, has done phenomenally well in last 10 years. Which means on an average, the retirement accounts, for them, the social security is earning them probably a fairly high single digit, compounded annual growth rate of returns. I think it will be it's a very difficult and a very challenging task ahead for Federal Reserve to slow down that kind of, wealth impact that it has on consumption. I think US per se, my belief is that they will have a fairly, they more likely than not, I believe they will stave off the recession. if at all they get into it, it's going to be a pretty shallow one to say the least. I think so. I think global consumption, I would be really less worried about US also. I might be more worried about Europe, where they are seeing a fairly large challenge in terms of energy prices, and which is also impacting their own manufacturing in a way also, right? So I would be slightly worried about Europe, but India and US, I'm not too worried about the consumption. And I think in both the places, I think discretionary will take a precedence over the non-discretionary spend.
So just kind of following up on what you mentioned, Europe being a concern, US not so much. So considering the global slowdown, especially in Europe currently, do you believe that domestic demand is going to be sufficient enough to drive growth going forward? What are your thoughts on this exactly?
So, we as an India have been domestic driven economy until probably a couple of years ago, a few years ago. But obviously there is a clear cut impact of China plus one, which is playing particularly in textile and specialty chemicals. I think that impact is now going to play out on Europe plus one also. Europe has been fairly strong in auto ancillary. They have been fairly strong in engineering goods. When we speak to a lot of companies over Q1 FY23 conference call, a lot of these companies in auto ancillary as well as engineering goods have already mentioned that they are seeing some shift of demand which is happening from the Europe exports to India exports. And I think the PLI scheme is going to go a long way in supporting that the export story. I think in a way PLI is not something that we are too excited about from the manufacturing theme point of view, because there are not many players which will be available who will benefit from that. But I think from PLI there are fair amount of forward linkages and backward linkages, and where there are a lot of listed companies which are available to invest. So like I said, from the consumption point of view, domestic demand is going to be fairly strong. I think from export point of view, what we are going to benefit from is China plus one, which is already happening since the COVID broke out. And now from Q1, we are also seeing that Europe plus one is also playing out in auto ancillary as well as precision engineering goods. And mind well, specialty chemicals, textiles, automobile, auto ancillary, and engineering goods. This is where Indian manufacturers are fairly strong, in terms of their manufacturing prowess.
So just last question, which is not really related to this, but AIF series 1 to 4 has seen really good success so far. According to you, what is the most important factor that has led to this success, the single most factor?
I would say actually it's one single factor, but I will break it up into two. One is our razor sharp focus on the quality. Either it is management or the business. We have our own proprietary model which is called eQual, Emkay quality model, and where we evaluate based on the publicly available disclosures the integrity and capability of the management and longevity of the business or scalability of the business. The art of the investment is that if you avoid the mistakes, your half job is done. You are half the way, right? So now I need to be worried about the only other half, right? So that's how we avoid the mistakes, through this eQual model. And we never compromise on that. That score which we get from eQual is a sacrosanct, and that's something which is carved in stone for us. The second part is about the discipline, and discipline both at the time of constructing the portfolio as well as our discipline as we ride through that portfolio returns. So we have a focused portfolio of just about 22 or 25 odd stocks. That's our sweet spot, and we never go beyond that. So it's a fairly focused portfolio, and it's also a concentrated one in a sense that whenever over the life of the fund we believe that a certain stock, because of its significant appreciation or exponential returns, is crossing a certain threshold limit, we cut our exposure there and bring it to more manageable level. And last but not the least on the discipline part is that eQual model is not a static one, right? We keep evaluating the same company on eQual model almost every quarter, whether it has slipped on that equal score, whether it has appreciated on that equal score. So once we follow that fair bit of discipline, I think half job is done. The other half is the normal equity research that and the valuation discipline that probably everybody follows.
All right. Thank you so much, Kashyap.